Let me introduce first to come up to the microphone, Dr. Darrel Good. Many of you know him well from the University of Illinois and on the bank board. Darrel, I'm going to turn the microphone over to you here about, less than 17 hours ahead of a major crop report. So tee it up for us and tell us what USDA is going to tell us tomorrow.
I'm going to keep that part a secret, I think, until we see how the market opens tomorrow. But I think they put me on the program first in order to put everybody in a good mood tonight, talking about the markets. But I want to spend just a couple minutes. I think it's helpful to try to characterize the corn and the soybean markets where we're sitting today. I think there's really three major factors that are having an overriding influence on our prices. One is obviously the supply of corn and soybeans. We are in a bit of an oversupply situation. We've had 3 consecutive years of pretty good crops here in the U.S. as well as around the world. 2012 was the last time we've had a major shortfall in production, and in that year it happened both in North America and South America. And one of the reasons we got such a price rise out of that drought in 2012. Since then, we've had generally fairly benign weather around the world and good crops, and we have begun to build our inventories of corn and soybeans, and overall that's pushed prices to lower levels. I think the other thing that's changed, and not necessarily for the good, is that we do have some problems on the demand side, and I think part of that is stemming from the slowdown in economic growth that we're seeing around the world. We're having some struggles with our own economy. It is recovering, but slowly. But some of the other major countries are struggling, and most recently, of course, we know the problems that are going on in China, reportedly. I'm not sure we ever really know what's going on there for sure, but it appears that their economy is slowing tremendously, and that's really been the engine of economic growth for the world the last 10 years. And kind of a spin-off from that, then the third factor is that the relatively strong economy here compared to the rest of the world means that we are seeing some currency changes, that the dollar remains strong relative to some of the other major currencies around the world, and that puts us in a little less competitive position in the world trade than if we had a weaker dollar relative to those currencies. So we're struggling with big crops, some competition from South America, some currency disadvantages. Consumption remains fairly robust, but I think what's happening is that with the weak demand environment that we're in, it just takes a bit of a lower price to maintain consumption at the level that we've been experiencing. So in order to see a turnaround in prices, then it seems to me that we need to see a change in one of those three factors that have pushed prices to the lower level. And in the short run, meaning the next 6 to 12 months, that's most likely to come from the supply side. And as Max indicated, we have an opportunity perhaps for that to start even tomorrow, depending on what USDA says with their latest forecast of the size of the corn and soybean crops. Their first forecast released last month was surprisingly large. The market didn't take it very well. The market continues to think that the USDA has overstated production potential on both corn and soybeans, and that their production forecast will have to come down perhaps starting tomorrow and in future reports in October and November. Everybody is focusing on the yield side right now, but there are still, I think, some lingering issues about acreage of both corn and soybeans as well. So the market expects USDA to show smaller numbers in tomorrow's report, perhaps showing the U.S. average corn yield to be a couple bushels less than what they forecast last month. I don't think that kind of decline would be enough to significantly improve prices. It would certainly help, I think, stabilize prices. I think we are probably nearing a bottom in the markets, And if recent price history is any indication, I think as we go forward, even in a lower price environment, we will likely see periods of rallies in prices. We saw that a couple times during the spring and the summer. They're pretty short windows, but we do get rallies, and I think moving forward we will have some opportunities perhaps to take advantage of those from a marketing standpoint. Right now it appears that corn may have a little better opportunity to rally than soybeans. Soybeans are in a bit more surplus. Reportedly, Brazil is expanding acreage and looking forward to another big crop there. And we rely more heavily on this export market for soybean demand than we do corn. So I think perhaps that's a bit of an uphill struggle for soybeans. But there will be opportunities when we will see some spikes. But again, I think better chances in the corn market. And if we go back to the old days when we had generally big crops and a bit of a surplus, we always experienced a decent rally in corn prices from the harvest lows, usually into the following late winter, early spring. And on average, we would see 50 or 60 cent rally in prices. I'm anticipating we'll see that kind of opportunity maybe more than once as we go through the next 12 months. So yes, it's going to be a low price environment. There will be opportunities from time to time. I think we kind of need to be geared up to take advantage of those as they happen.
So Darrel, like one analyst said to me the other day, be prepared for some base hits, but don't expect a home run.
I think that's well said. That's what we've experienced for the last 6 to 9 months. We've had periods of base hits when you see the corn market and soybean market rally 30, 40, even 50 cents. It wouldn't last long, but we had a couple opportunities like that. It's hard to say exactly what would trigger that. Again, I think it's most likely supply interruptions or supply concerns as we go through the South American growing season and then back into the North American growing season next spring. I would anticipate we'll see periods of production concerns and some price spikes.
There's a lot of attention on the Federal Reserve right now, the possibility they might start finally, after all of this time, ratcheting up interest rates a little bit. What happens in terms of the ag economy, if any impact, if that starts?
You know, I had that question from another source today, and there's probably a lot more ramifications than I'm aware of, but if we start with fairly modest increases in interest rates, which is what the Fed is talking about, and then a slow pace of increase, I'm guessing that will not have a major impact on the commodity markets per se, but I think the one thing that we've been told is, and rightfully so, is the thing that has supported the farmland market the last several years is a combination of fairly high incomes and low interest rates. And if we start seeing interest rates now start creeping back up, I think that will raise some concern about the ability of farmland prices to maintain in an environment of lower income. I would say that would probably be the most immediate impact is some weakness in the land market coming from higher interest rates.
How about a quick question from the audience? Anybody have a question they'd like to pose of Darrel? All in and all done. And one quick question about China. You know, we anticipate if their economy is slowing, they might scale back purchases of things like coal and maybe some of the other things that they need for their industrial machine. But somebody said, you know, they're still going to need grain. Would they also, if they have a slowing economy, scale back purchases of agriculture commodities to feed their livestock and to feed their people?
I think most people would be in agreement that food security is a big issue for China, and that they're really not going to put their food supply in jeopardy if they can help that. And so I think from a quantity standpoint, they will continue to be large buyers of soybeans, fairly large buyers of feed grains, although recently that's been sorghum
Yeah.
rather than corn. Then the question is, this rapid expansion that they've seen in their livestock industry there, will that in fact begin to slow if the economy does slow down? Right now, the thinking is that domestic production there may slow down, but China would perhaps be willing to be more reliant on the import market, even for livestock products. So I think from a quantity standpoint, it's this quandary. They're going to continue to buy large quantities, but they're going to be looking for bargains. It's a weak environment. They're going to be looking for low prices. They're going to, right now, buying everything from South America because of the currency situation, and that's putting us at a bit of a disadvantage.
Darrell, thanks so much. Really appreciate it, sir.
Thank you.
How about a big round of applause for Darrell Good?